Hello everyone, welcome to my channel. Today, let's analyze how the stock market will perform next. I am a swing investor, and I will not consider the stock price changes of a stock 1 month later. This channel only makes short-term predictions on stock prices, usually 1 to 3 weeks. Welcome to subscribe to this channel. Let's first technically analyze the current position of the S&P 500 index. The index has now broken through the falling channel and has risen further, but not too much higher. Obviously, the index feels a certain amount of pressure at its current position, mainly because the market lacks catalysts for further increases. April 22nd is a key turning point in the market. This is the second wave of corrections in the index in April. This shows that in early April, due to the sharp drop in stock prices, a large amount of long capital entered the market to buy the bottom, and these long capitals seem to have not yet exited the market, so the market has continued to rise in the past 2 days. It is worth noting that the trading volume has not increased significantly in the past 2 days, which means that the index still has the possibility of further rise. But this may also put the market under greater selling pressure, because some profitable capital may choose to exit with profits, and the stocks of some companies with lower than expected performance may drag down the stock index. Next, let's look at a piece of news. Recently, some media pointed out that a large amount of capital is fleeing the United States, especially the stock market. The sharp decline in the stock market in the past 2 months has indeed raised such questions. But after hitting the bottom in April, the stock price rebounded strongly, and investors' bearish sentiments seem to have declined, and their confidence in the market rebounded significantly. Why is this the case? First of all, from the long-term value of global assets, no country's assets can surpass the United States in long-term value. In April, the United States imposed high tariffs on the world, but don't forget that the United States is still the world's largest single consumer market. If the United States falls into a recession due to tariffs, the economies of other countries will decline more severely, which is why, except for China, other countries choose not to retaliate against the United States on tariffs. So some capital may flee the stock market in the short term because of tariffs and enter gold, bonds, or other safe haven assets. But these assets may not be able to rise in the long run. The recent sharp drop in gold prices is a proof. But as far as the stock market is concerned, the stock markets of other countries have also fallen significantly due to tariffs, but the U.S. stock market appears to be more resilient, so some capital will eventually flow back to the U.S. stock market after exiting the U.S. stock market, and the stocks of some companies with good performance still have long-term investment value. Regarding the tariff war between the United States and China, I think it seems difficult for the two countries to reach an agreement in the short term. China said on Thursday that it has not yet negotiated with the United States on a potential trade deal. But recently, reporters filmed Chinese officials going to the United States for trade negotiations. So who is lying? But no matter who is lying, I think both sides now want to go to the negotiating table to see what the other side wants. Especially China. If the U.S. asking price is too high and Chinese officials believe that this agreement will affect China's regime stability, then obviously no agreement can be reached. But if the White House just wants China to buy more from the United States and reduce the U.S. trade deficit with China, then there is a high possibility of reaching an agreement. But even if an agreement is reached, confrontation in other areas may continue. But the United States is likely to reach an agreement with other countries. The United States' long-term high tariffs on other countries will also hurt the United States itself. So in the next few weeks, the White House may announce trade agreements with other countries. Obviously, this will be good for the stock market. Let's take a look at which companies will release first-quarter earnings reports next week. There were no earnings reports from large technology companies on Monday and Tuesday, which means that the impact of these companies' earnings on the S&P 500 index was limited, but the impact on the Dow Jones index may be greater. However, large technology companies such as Microsoft, Meta Platforms, Qualcomm, Amazon, and Apple released their first quarter earnings reports on Wednesday and Thursday. There is no doubt that this will have a certain impact on the stock market. However, since certain types of chips, hardware and iPhones are still exempt from tariffs, this means that the sales of these companies in the first quarter are limited by the impact of tariffs. Of course, this does not mean that the stock market will not fall. Some companies with lower than expected performance may cause their stocks to fall sharply, which may drag down the overall performance of the stock market. Let's go back to the daily chart of the S&P 500 index. Although the market lacks catalysts for further increases, there does not seem to be a bomb in the market on Saturday and Sunday that can cause the market to fall sharply. Although the market has accumulated a large number of profitable positions in a relatively low area in April, the profit space at the current position is limited, and the withdrawal of some capital may not lead to a significant downward adjustment in the market. In summary, I think it is more likely that the S&P 500 index will consolidate at a certain level, ranging from about 54.20 to 56.20. But if the earnings of several major technology companies on Wednesday and Thursday are lower than expected, this may drag down the entire market and may cause the S&P 500 index to fall below 54.20. Of course, as mentioned earlier, there seems to be nothing that has caused a sharp drop in the market recently. But as far as quarterly earnings are concerned, the impact on the market is limited. So even if the market pulls back again, it is expected to be difficult to fall below 52.90, and then the market will rebound again. Okay, guys, this is my prediction for the S&P 500 index. Thank you for watching. If you agree with my analysis, please share and subscribe to my channel, and see you in the next video.